Welcome back to the channel, where we delve deep into the world of finance to help you make informed decisions about your investments. Today, we're tackling a fundamental question that many investors face. Should you invest in individual stocks or index funds? Both options have their merits, and understanding these differences can profoundly influence your financial journey. So let's explore this topic thoroughly and reflect on what might work best for you. First, let's talk about liquidity. When you invest in individual stocks, you're typically purchasing shares of a specific company. If you need to sell your shares, the process is relatively straightforward. You can sell them anytime during market hours at the current market price. However, liquidity can vary depending on the stock's trading volume. For example, a well-established company like Apple will generally have high liquidity, making it easy to buy or sell shares. Conversely, smaller companies may not have the same level of activity, which could lead to challenges if you need to liquidate your position quickly. On the other hand, index funds are collections of various stocks that aim to replicate the performance of a particular market index, like the S&P 500. When it comes to liquidity, index funds tend to be fairly liquid as well. They can be traded at market prices throughout the day, like individual stocks. However, unlike single stocks, index funds offer built-in diversification since they encompass a wide array of companies. This means that while you may still experience price fluctuations during market hours, the impact on your investment might be cushioned by the performance of other holdings within the fund. Next up is accessibility. For many investors, especially those new to the market, index funds offer a more straightforward approach. They require less research and time commitment compared to picking individual stocks. With just one purchase, you can gain exposure to multiple companies across various sectors. Many brokerage firms now allow you to start investing in index funds with minimal initial investment, making them accessible to nearly everyone. Conversely, investing in individual stocks requires a deeper understanding of each company's fundamentals, its earnings reports, management team, competitive position within its industry, among other factors. This level of analysis demands time and effort that some investors may not be able or willing to commit. However, for those who enjoy researching and tracking specific companies closely or have a knack for identifying emerging growth opportunities, investing in individual stocks can also feel highly rewarding. Now let's discuss profitability. Historically speaking, individual stocks have the potential for higher returns compared to index funds, if an investor selects winning companies that experience substantial growth over time. The allure of potentially hitting a home run with a single stock can be incredibly enticing. However, it's essential to remember that higher potential returns come with increased risk. Individual stocks are often more volatile. They can rise rapidly but also fall sharply based on news events or changes within the company or its sector. The possibility of losing your entire investment is higher when you concentrate on a few stocks rather than spreading risk across many through an index fund. Index funds typically provide steadier returns over time due to their diversified nature and alignment with broader market trends. Although they might not offer the same explosive growth as some successful individual stocks, they have historically outperformed a significant number of actively managed funds over long periods. This steady growth aligns well with many investors' long-term financial goals. We must also consider psychological factors when choosing between individual stocks and index funds. Investing in individual stocks can evoke strong emotions, excitement when a stock performs well, and anxiety during downturns. These emotional responses can lead to impulsive decisions based on fear or greed rather than solid investment principles. Index funds often mitigate some psychological stress because they promote a buy-and-hold strategy rooted in diversification rather than attempting to time the market or pick the next big thing. For many investors seeking peace of mind and lower anxiety levels while navigating their financial journey, index funds may present an attractive option. In conclusion, both individual stocks and index funds come with distinct advantages and challenges. Your choice should align with your financial goals, risk tolerance, available time for research, and emotional comfort level during market fluctuations. As you reflect on these factors today, I invite you to share your thoughts in the comments below. Do you prefer the excitement of selecting individual stocks or the steadiness offered by index funds? Let's engage in this conversation together. Your insights could help others make informed decisions too. Don't forget to like this video if you found it helpful and subscribe for more content designed to enhance your financial literacy and investment strategies. Thank you for tuning in today. I look forward to seeing your comments.